The retirement planning process at Ivy League Financial Advisors in Rockville, Maryland. At Ivy League Financial Advisors, we understand that retirement planning begins years before you retire. We know that each client's situation is unique, and we also understand the financial and personal aspect of this life transition. We understand that each client's vision of retirement is different, and we understand that each client may be at a different stage of retirement preparation. For this reason, we take the time to have a detailed discussion of your retirement goals, examine your personal balance sheet and annual cash flows to understand your capital needs in retirement, and run numerous retirement scenarios as a means of stress testing the potential success of your retirement. While our experience tells us that every client's retirement situation is unique, the majority of our clients' major concerns can be summarized by one question. Can I or we live the lifestyle we want to live in retirement without worrying about running out of money? Addressing this question first starts by realizing that there are two major stresses on a retirement portfolio. One, cash flow or income to meet annual needs, and two, long-term growth to offset inflation. So our challenge as a financial advisor is to design a portfolio that allows clients to live their chosen lifestyle in retirement without worrying about daily market fluctuations and allowing the portfolio to grow over time. So how do we address all of these issues and properly plan for our clients' retirements? The Ivy League retirement planning process is a structured process which addresses all of these concerns. First, we must calculate what we call the client's gap, the annual cash flow which needs to come from a client's portfolio. The first step in determining the client's gap is determining the client's annual expected income in retirement. This can come from many sources, but usually comes from a client's Social Security payments and their pension, if they have one. Next, we must determine the client's expected annual expenses in retirement. This number will probably vary, but getting a solid idea of what a client's anticipated yearly expenses will be once they retire is important. The difference between the client's annual income and the client's annual expenses is the annual gap, the annual cash flow which must be funded from a client's retirement savings. Numerous retirement studies have asked the question, how much can a person annually withdraw from a portfolio without taking the risk that the portfolio will be exhausted during the person's lifetime? Study after study has shown that a withdrawal rate of 4 to 5% annually is an acceptable rate. In reality, this means that for every $40,000 to $50,000 of annual cash flow that clients want to withdraw from their portfolio, they need $1 million in retirement savings. After determining the client's gap, we then design a portfolio to support the gap. After the gap is determined, we design a withdrawal portfolio by grouping the client's assets into one of three categories, or buckets: short-term, medium-term, or long-term. We then select appropriate investment vehicles for each, primarily based on when we expect the assets to be used. This design is very important for our clients because it allows them to visualize how their retirement savings will be invested and why. So to show you how this works, we allocate the first 3 years of a client's annual cash flow needs to investments such as money market funds, short-term bond funds, or CDs. While these investments may not produce high returns, they're generally stable and maintain their value in market downturns. We then allocate the next 3 years of a client's annual cash flow needs, or years 4 through 6, to balanced mutual funds, funds which contain an allocation to both stocks and bonds. These investments have the potential for higher returns than money market funds or short-term bond funds, yet they tend to hold up fairly well in market downturns. Finally, we allocate the remainder of a client's retirement savings to the client's long-term need for capital appreciation, or growth. We do this by placing the client's retirement savings in a diversified portfolio, a portfolio of U.S. equities, international equities, bonds, real estate, and alternative investments such as commodities. The target of this portfolio is long-term growth and is not intended to be drawn on for at least 7 years. To make the withdrawal portfolio as tax efficient as possible, withdrawals come first from a client's taxable account before they are taken from a client's IRA. In designing the portfolio, we also consider the client's minimum required distribution and the tax efficiency of investments composing the portfolio. For example, to the extent possible, we place tax-inefficient investments, such as bonds, within tax-deferred vehicles, such as IRAs. Every 1 to 2 years, as assets are depleted, we rebalance the portfolio and move long-term assets into medium-term assets, and medium-term assets into short-term assets. This assures that the client's retirement gap is always funded. After the withdrawal portfolio is designed, it must be implemented. We draft a strategic plan known as an Investment Policy Statement, or IPS, which contains the specific details of how the portfolio is to be managed. Clients sign off on the investment policy statement so both parties are in agreement as to how the portfolio will be allocated. To make the portfolio as easy to manage as possible, we consolidate and combine investment accounts. For example, multiple 401ks are rolled over and combined into IRAs whenever possible to allow for easier implementation and to simplify the client's lives. We also make sure that the client's estate plan is implemented by retitling accounts accordingly, for example, into revocable living trusts. We also update the client's beneficiary designations as appropriate. Finally, securities are bought and sold in accordance with the investment policy statement. In doing so, we try to be sensitive to recognizing taxable transactions, such as generating capital gains. We also review other issues which are essential to a successful retirement. We analyze the client's Social Security options and make recommendations as to when they should file for Social Security. We review the client's estate plan to make sure it is structured properly for their situation and that all the I's are dotted and the T's are crossed as it is implemented. We educate clients about the pros and cons of long-term care insurance and obtain quotes from reputable insurance agents. Now let's take a look at an example of a withdrawal portfolio to get a better idea of what exactly we do for our clients. To set up this particular client scenario, you need to know that the client has $4 million in their retirement portfolio, and in order to live comfortably in retirement, they need to withdraw $160,000 each year, which equals 4% of their total portfolio. So the question is, how do we structure the portfolio so that the clients won't have to worry about short-term market volatility, yet ensure that they won't run out of money in retirement? First, we allocate their funds according to our bucket system. We put 3 years' worth of assets in a low-risk portfolio of short-term bonds or money market funds, which equals out to $480,000 or $160,000 per year for 3 years. We put the next 3 years of assets in moderate risk balanced funds. This equals out to another $480,000 or $160,000 per year for 3 years. The remainder of the portfolio, which is their long-term allocation and won't need to be drawn on for at least 7 years, is allocated into a diversified portfolio of equities and fixed income. These long-term assets amount to a little more than $3 million. The short-term objectives of the client are addressed by providing an annual cash flow to them in retirement without having to worry about the daily fluctuations of the market. This gives them peace of mind over their portfolio and their annual stream of income. Their long-term objectives are also addressed by making sure that we invested in assets which traditionally grow faster than inflation, such as equities or stocks, held in a diversified portfolio. Our goal is to grow this $3.04 million portfolio back into the original amount of $4 million in 6 years, effectively reloading the buckets. This makes sure that the portfolio continues to grow, while also ensuring their stream of retirement income for the foreseeable future. You may ask, well, just how likely is this strategy to be successful? In this example, the rate of return required for us to grow their $3.04 million diversified portfolio back to $4 million in 6 years is only 4.68%. This is a very reasonable rate of return over a complete business cycle. Historically, U.S. stocks have returned approximately 10% annually over the long term, while bonds have returned approximately 5% annually over the long term. Please keep in mind that the higher their annual withdrawals, the higher the required rate of return would be, and the more stress that would be placed on the portfolio. As you can see, Ivy League's retirement planning process is structured to address all short and long-term needs of the client, so that they can have peace of mind during their retirement years. For more information about our retirement planning process or about how we manage investment portfolios, please visit our website at www.ivyfa.com.